Most people believe the Great Recession ended in 2009. The stock market recovered, banks survived, and the headlines moved on. But what if the real story wasn't the crash itself, but everything that happened after? What if the world never actually returned to normal, and the economic rules millions of people still follow today are based on assumptions that quietly died more than 15 years ago? This is the story of how a financial crisis that began with a handful of risky mortgages reshaped the global economy in ways most people still don't see, and how the decisions made during those chaotic years created the foundations of the world we live in now, where housing is unaffordable, wages can't keep up, debt is the new normal, and entire generations feel like they missed the prosperity window their parents took for granted. And it begins with a mystery. How did a crisis so temporary change the economy forever? To understand what really happened, we need to rewind, not to 2008 when the collapse finally hit, but to the years before, when the system looked stable, when banks were confident, when economists believed they had solved the riddle of boom and bust cycles. The 1990s and early 2000s were built on a promise that financial engineering, globalization, and technology could create a world of endless growth. The United States Federal Reserve under Alan Greenspan had successfully navigated crises from the 1987 crash to the dot-com bubble. Investors started to believe the Fed had a magic button. Whenever things got rough, interest rates could be cut, and the economy would bounce back. This belief encouraged more borrowing, more risk, and more confidence that nothing truly bad could happen. But the seeds of danger were already planted, and almost no one realized it. Mortgages, one of the most boring parts of finance, slowly evolved into something far more dangerous. Banks didn't want to hold loans on their balance sheets anymore. They wanted to sell them to Wall Street, which turned them into complex financial products with names like collateralized debt obligations, mortgage-backed securities, and synthetic tranches that only a small group of experts really understood. Suddenly, mortgages weren't just home loans. They were tradable assets, generating huge profits. This created a simple but devastating incentive. Write more mortgages, no matter how weak the borrower. And as long as housing prices kept rising, the system appeared safe. On the surface, everyone won. Borrowers got homes, banks got fees, investors got high returns, and the government got the illusion of a booming middle class. Beneath the surface, pressure was building. As more and more mortgages were issued, lenders began lowering standards. No income, no job, no assets loans. Adjustable rate mortgages that started cheap but exploded later. Housing developers built entire neighborhoods on speculation, assuming demand would never end. And when early warnings appeared, like rising defaults in 2006, they were dismissed as minor problems. After all, economists insisted that housing prices had never fallen nationwide at the same time. The system, they said, was too big to fail. The irony, of course, was that its giant size was exactly what made the risk catastrophic. By 2007, the pressure inside the system finally reached a breaking point. Interest rates rose. Homeowners who had taken adjustable mortgages couldn't afford the new payments. Foreclosures spiked, pushing housing prices down. That single shift, prices falling instead of rising, was enough to trigger a chain reaction. Investors realized the mortgage-backed securities they had treated as safe were suddenly toxic. Hedge funds collapsed. Liquidity evaporated. Stan O'Neill at Merrill Lynch, Richard Fuld at Lehman Brothers, and chief executives across Wall Street scrambled to raise capital and reassure investors. But confidence isn't something you can patch together with press conferences. It's fragile, and once it's gone, the entire structure collapses. The moment that truly sent shockwaves through the global economy came in September 2008, when Lehman Brothers, once one of the most powerful financial institutions in the world, declared bankruptcy. It was the largest bankruptcy in American history. In the days that followed, money markets froze, banks refused to lend to each other, and the fear spread beyond finance. Companies stopped hiring. Consumers stopped spending. Governments scrambled to prevent a complete collapse. And yet, even in the middle of the chaos, one big assumption remained: that once the panic settled and stimulus was pumped into the economy, everything would go back to normal. That assumption turned out to be wrong. The bailout programs, stimulus packages, and emergency interventions saved the financial system from collapsing, but they also created a new economic reality. Interest rates were pushed to near zero and kept there for years. Central banks printed trillions of dollars to buy bonds, support markets, and restore confidence. These decisions felt temporary at the time, but they reshaped the global economy permanently. Cheap money inflated asset prices, from housing to stocks to technology startups, far beyond what traditional economic fundamentals could justify. Savers earned nothing on their deposits. Investors earned everything by taking risk. Wealth shifted upward. Inequality widened dramatically. At the same time, something else changed. Productivity slowed. Wage growth stalled. Young people entered the job market during a period of deep uncertainty, carrying heavy student debt and facing a labor market that no longer promised the stability their parents had. Homeownership became harder. Corporations, able to borrow cheaply, focused on stock buybacks instead of long-term investment, and governments, fearing debt, embraced austerity measures that slowed recoveries further. What was once described as the new normal eventually stopped being new and simply became reality. When economists look back at the decade after the Great Recession, one of the most shocking patterns they see is how long the scars lasted compared to previous crises. Normally, unemployment recovers quickly after the shock ends, but this time, it took nearly 6 years for the job market to heal. Household wealth, especially for middle-class families, didn't return to pre-crisis levels for almost a decade. Entire regions of the United States experience what researchers call lost economic mobility. Young people raised in those areas had a significantly lower chance of upward movement compared to previous generations. And globally, the crisis accelerated a political shift. Distrust in institutions, the rise of populist movements, and skepticism toward globalization. But the most important long-term impact wasn't any single statistic. It was the way central banks and governments fundamentally changed their approach to economic policy. Once interest rates hit zero and stayed there, the old playbook no longer worked. Instead of preventing crises, policymakers found themselves managing an economy hooked on cheap money. Any attempt to raise rates triggered market panic. Any sign of tightening made investors nervous. This created a paradox. The policies designed to stabilize the economy made it more dependent on intervention. And that dependence led directly to the world we saw in the late 2010s and early 2020s, an economy driven by speculation, inflated valuations, and fragile confidence. When the pandemic hit in 2020, the world once again turned to massive stimulus, low rates, and government support. But this time, the scale was even larger. The result was predictable: a surge in asset prices, followed by the highest inflation in roughly 4 decades. Suddenly, everything people had grown used to since the Great Recession, cheap borrowing, rising markets, predictable growth, was replaced by uncertainty once again. The parallels were impossible to ignore. A crisis leads to extreme policy responses. Those responses inflate imbalances, and the imbalances set the stage for the next crisis. It's the same pattern repeating, just with different triggers. This raises a question that economists debate but ordinary people rarely hear. Did we ever truly recover from the Great Recession, or have we been living in its shadow ever since? The evidence suggests the latter. The housing affordability crisis dominating headlines today began with post-2008 policies. The explosion in corporate debt traces back to years of ultra-low interest rates. The fragile supply chains exposed during the pandemic were built during the 2010s as companies cut costs to survive slow growth. Even the rise of mega-technology companies worth trillions of dollars was fueled by cheap capital seeking the next big opportunity. In other words, the Great Recession didn't just scar the economy, it rewired it. And yet, there is one more twist. While the crisis taught us that unchecked risk can destroy economies, some of the reforms intended to prevent another crash created new vulnerabilities. Banks became safer, but shadow banking grew. Mortgage standards tightened, but investors bought homes in bulk, driving up prices. Regulations improved transparency, but financial innovation adapted to new loopholes. The risks didn't disappear, they shifted. As we look at today's economy, with high inflation, rising interest rates, geopolitical instability, and record debt levels, it's hard not to see echoes of the past. The warning signs are similar: overconfidence in central bank tools, markets priced for perfection, households stretched thin, and policymakers facing impossible choices. The Great Recession showed how quickly a supposedly stable system can unravel. The question now is whether we've learned anything from that experience, or whether history is preparing to repeat itself in another form. 3 lessons stand out. First, stability can be dangerous when it leads to complacency. Every calm period in modern financial history has been followed by bold risks that eventually backfired. Second, crises don't end when markets rebound. Their real impact unfolds slowly, reshaping behavior, policy, and opportunity for years. And third, the decisions made during moments of panic have consequences far beyond what anyone can predict. They set the economic rules for an entire generation. If there is a warning to take from all this, it's simple. The next major economic shift won't announce itself with headlines or dramatic collapses. It will begin quietly, the way most crises do, with patterns we've seen before but choose to ignore because they don't fit the story we want to believe. And if the Great Recession taught us anything, it's that ignoring those patterns comes with a cost. If you want to understand these cycles, the hidden forces shaping today's economy, and the repeating mistakes that keep creating new crises, make sure to subscribe, leave a like, and watch the next video. Because the story of the global economy isn't finished, not even close.